will be in focus today. L&T reported what was a mixed bag of Q3 numbers on Saturday. Anisha is here with all of the key takeaways. Anisha, over to you.
Well, yes, it was a mixed set because the top line was weaker than anticipated, but the quality of earnings is improved. So I'll start with the negatives first. As I mentioned, the top line was up just 1% versus an expected growth of around 8-9%. And also the fact that the company has cut down its revenue guidance and order inflow guidance now to 10% also might be a dampener as well. Given the fact that the depreciation was higher this time around, because they had taken an impairment on Seawood's Mall. Now, why this is important is because right now they have taken impairment on just Seawood's Mall and not the entire Seawood's property, and this means they might have to take an impairment loss in the coming quarters as far as Seawood property is concerned. Also, in terms of the segmental performance, the development projects and power segment has not done well this time around. They were doing well in the last couple of quarters. This time they have surprised negatively. However, why I think the stock might not react that negatively is given the fact that the quality of earnings has improved. So if you look at the internals, the operational performance has come in at very strong. So EBITDA margins is up about 140 basis point year on year, and they have maintained the EBITDA guidance of improvement of 50 basis point in FY17. The order inflows, though, were down 10% year on year. They were much better than expectations. We were working with a number of 25 to 30,000 crores, but this time around they have come in better. Also, in terms of the working capital, now that comes as a real positive. The working capital as a percentage of sales now is at 21% to sales versus expected, versus the year beginning, which was 25%. So 400 basis point improvement in working capital is a real positive, and that is why the cash flow from operations have become really strong. Also, lower losses from associate and finance costs is lower. That has aided the profit growth of 39% year on year. In fact, for the first 9 months, the profit growth is 59%, and that from this giant is not a mean feat. In terms of what brokerages have to say, JP Morgan, for example, says that they recommend adding L&T ahead of its March numbers because on basis of the revised guidance, March quarter is expected to give out double-digit growth. So that is really positive. BofA on the other hand says that L&T might miss it, even its revised guidance, and that is why they have cut down the EPS targets by 12 to 20%. Back to you.
All right, Anisha, thanks so much for joining in.